Thank you. So we're going to do a quick change out here. Our final panel of the day is the financing panel. Sorry, Lisa. Our moderator is my co-host. My company, New Being Capital, and Black Emerald Capital have jointly put this conference together and have been working together on it for about 6 months now. Both Oleg and I, our day jobs are in VC, and so this is a panel that's near and dear to both of our hearts. So I'm going to invite Rob at AgFunder, David at USDA, and Joe Hudson at One Earth Capital to join us up here. So while they're assembling, I'll just introduce the panel. Joe's biggest claim to fame, though he's got some others, is that he is one of the first guys to have funded Pam Marone, whose business you saw her discuss this morning. And he has a long-standing interest in agriculture as a consequence. David is our guy on the ground here for funding at the USDA, and he's really every local farmer's first port of call and first discussion when they're looking at incremental funding. And Rob has done something really unique. He has created an online platform where you can go online and you can invest in agriculture projects and you can own a piece of the equity in those projects. So with no further ado, I'm going to hand it over to Oleg.
Thank you. And Nicola, before you leave, the one person who hasn't been thanked here today is Nicola, who has spent a significant amount of time and energy on this conference. And you also took a little bit of the wind out of my sails. I was going to introduce the guys, but yeah. Well, I know that as the last panel, we also stand between you and cocktail hour, but this is going to be a really interesting panel, especially for those of you who are thinking about fundraising, so please stick around. So over the past couple of years, we've seen multiple investments that have been made in the ag and ag innovation space, from Engen's investment in Bright Farm to One Earth Capital backing Pam's company, which went public, so good on you for that, as well as Coastal Ventures and other venture funds investing in real-time soil measurement companies and others. But have any of you wondered, well, why is it that some of these companies seem to get funding so easily, although it's not necessarily all that easy, whereas others might struggle a little bit? And that's really what we're here to talk about with the help of our panel, to try to make the funding options and processes a little bit less mysterious. But first, just a really quick survey. Please raise your hand if you're either thinking about starting a business or expanding your business and are probably going to be thinking about some kind of outside capital, regardless of the type of capital. Okay, awesome. Well, so Nicola already made a little introduction. I do want to say Rob is also one of the only investors I know with 5 degrees, one of which includes computational biology, which is pretty cool. Not a lot of investors running around with that type of pedigree. Well, so before we jump into it a little bit, I know there's been a little bit of an intro, but if all 3 of you could just say another couple of words about what it is that you do and about the organizations that you run, that would be great.
Sure.
Why don't you start, Rob?
So I'm Rob Leclerc. I'm the CEO of AgFunder. We started AgFunder because I had some problems raising capital for another ag startup that I was working at. We were there for about 3 years. Great pilot project. We had lots of seed capital, a great board of advisors, but we really struggled to raise capital for an ag company. And so we saw, in particular I saw, because my background was really in technology, an opportunity to use the internet to bridge some of the gaps in and sort of consolidate the opportunities in agriculture around the world, because really there's no center of gravity. We can be in Las Vegas, we can be in California, we can be in Chicago, we can be in Africa, and agriculture is everywhere. And finding the investors for those projects can be difficult. Not all investors invest in agriculture, but there may be 5 to 10% of them out there that do. And so we are trying to consolidate all of that together at AgFunder. And so www.agfunder.com, just keep that in mind. So I'll take it for the rest of the panel to
So my name's Joe Hudson. Started a venture capital fund around sustainable agriculture around 8 years ago. So we've been investing solely in agriculture for 8 years. Up until about 3 months ago, we made our first investment in a non-agriculture company, but we found it through agriculture and somewhat agriculture related. Anyhow, we look for really great teams of people with a great technology, with high margins, with IP protection, with a great team of people, with a great team of people, with a great team of people. There's a golden rule of venture capital that is there is no idea so good bad management can't screw it up. And I just can't tell you how true that is. So I think that's generally a nutshell of what we do. Yeah.
Good afternoon. I'm David Foster. I'm from the USDA Rural Development. I'm a business program specialist here in Southern Nevada. So first, I'd like to welcome you all here to Las Vegas. Please have a good time, spend lots of money, and have a good time. I administer our 16 programs that are designed to help small businesses start, grow, thrive, and survive. And I look at indoor agriculture as small businesses. I assume that as we progress here, I'll talk more specifically about my programs, but big picture, that's what I do. I'm here to help you guys start, grow, and create jobs, particularly in rural areas. And while I'm based here in Southern Nevada, there's one of me in every state in the country. Lots of me.
Thank you.
Thank you, Carol.
So first question is really to Joe. We have only to look at the last decade of clean tech investing to see how challenging it is for investors to try to have some type of social or environmental impact while maintaining decent returns. So in looking at the ag innovation industry, and really even more specifically indoor and controlled environment farming, how is this any different, and why is it different, and why now?
Yeah, no, I don't think it is. I think there's going to be a lot of investors who lose their shorts. I think so. The things so venture capital does really well if you don't have a lot of capital expense to build your business. So software does really well, mobile technology does really well, medical devices do really well, and then when they do things like build huge batteries or new cars, it's a trickier model. And you guys are in the new car kind of big battery thing because you have this large capital often. So I think that there's some segments where venture capital will do really well. You know, precision irrigation, we have an investment there, and we think it's doing quite well because we don't have that huge capital expense. But there is ways in which venture capital historically have done well with large capital needs. And what they do is they partner with 3 or 4 other venture capitalists and they syndicate. And that's how it's been done in the pharmaceutical industry. But nowadays, with venture capital the way that it is, they have so much money that they all are trying to hoard deals and have their one deal, or maybe have one other person with them. And if that happens, then they'll kind of suffer the fate. And if you look at the clean tech landscape right now, most of the funds who were in it 7 years ago are out of money. And so it's been a massive pain point for venture capital in general.
Yeah, scalability, I think, is another factor, a factor here that he mentioned. I mean, with software, it's much more replicable with some of these sort of indoor farming ideas. They may work at a small scale, but they may not scale well. And so that's something that the VCs need to consider when they're looking at these projects. So, you know, a Snapchat can scale to, I don't know, 100 million users, but can you scale your operation to 100,000 people? So it's sort of a different risk that they need to consider.
Yeah, I would say that, especially if the technology is farmer-facing. So if I invest in a tech like the coolest LED lighting company, right? The thing about farmers is, especially in America, is you're super cheap. And I don't mean that in a bad way. I think if you look at the bottom line of a farmer, if you save 5 cents on your pound, you can double your return on investment in your assets. So it makes a lot of sense to really be conservative in how you spend your money. But that goes for slow adoption, and slow adoption drives good technologies out of business quickly. So when I get calls from people saying, hey, we want to invest in agriculture, what do we have to look out for? Customer adoption is the biggest issue that they bring up, and it's the biggest issue that we've faced. It's incredibly slow. Now, in Brazil, completely different. All the growers there were insanely aggressive with technology and made a ton of money. And so they buy technology like it's, the next new thing. They just know that they're going to make money from it. But the American farmer does that a lot slower. And what you're seeing is the productivity rise in non-American farming, like unbelievable amounts. If you go 7 years ago, I went to Indonesia and I looked at sugarcane plantations at 50 tons a hectare. It's at 120 tons a hectare now. Right? They are just making hand over fist of money and believing in technology. The American farmer is much slower, except for some of the big private equity-owned farms.
So you're giving insight from the VC perspective, but what about some of the larger institutions or family offices that, whether they're supporting you or making direct investments, what's driving them? I mean, is it the same, just pure ROI, and they think they can make a decent return there, or is there a bigger motivation?
Family offices?
A little bit. I mean, we've spoken to a couple, and there's certainly one aspect of it is diversification of their portfolio, and so they're looking to agriculture as something that has real tangible value. And so the other is there's a certain ethos in agriculture, I think, that a lot of family offices seem to like. A lot of them seem to own some sort of ranch or have some sort of connection to the environment, because that's maybe a luxury these days for a lot of people who live in the urban societies. So that's certainly just a driver, is wealth preservation, diversity of capital, and then there's a new ethos about agriculture. Certainly we're playing into these long-term secular trends, and they have the ability to have patient capital in agriculture, and they're not necessarily looking for 20% year-on-year returns, but more preserving their wealth.
Yeah, I'd say most of the family offices. So I work for a family, and I've recently opened my fund to other family offices. I don't work with institutionals. So Fortune 100 families, I deal directly with about 10 of them. So a lot of them want the land for the reasons that you just explained, that they want to buy big tracts of land because you got to get 10% return on investment year over year, historically rated over like the last 60 years. So that they like those odds. What they miss generally is that running a farm is a team thing as well. There is no idea. So good, bad management can't mess it up, and you see a lot of farms go south because it's bad management. So they often miss that fact. But a lot of them are doing it because they're foodies and they like food and they care about food. And some of them are already suffering because of that, so you might see that trend subside. The other thing that's happening is there's a lot of the very wealthy people who think that food systems have to change to be able to feed populations. So you're seeing Hampton Creek, if you're familiar with that deal. It was a fake egg. It's a Canadian yellow pea turned into an egg. And they raised money without revenue at $80 million pre-money valuation from Bill Gates and from the richest man in Hong Kong, because they think that because they're on the mission to save the world. So feed the world. So there's a lot of reasons why people invest in it. A lot of them I find are not financial.
So that may actually be a good transition to the talk about the pool of available capital. As the founders and CEOs of the companies here start thinking about whom to go to. I mean, who are you seeing out there who's really interested in the indoor farming side of the equation, whether it's on the production, LED lights, distribution, whatever it might be? Is it really mostly the VCs, or is it more debt, family offices? Where are you seeing the most activity or the most interest?
Well, I'm seeing debt as part of the equation. And again, part of the reason that I'm here is to talk about some of my programs. And one of my primary programs in my toolkit of 16 programs is our business and industry loan guarantee program. So an indoor ag producer can obtain debt from a lender, whether it be a bank or a credit union, savings loan, whatever, any qualified lender. And I can guarantee a huge chunk of that loan to that lender should the producer ever default. It's an enticement for a lender to make a loan that they otherwise wouldn't make. It's a lot like the SBA's 7A loan program, which is their primary program. It's different in many ways. Mine has a rurality component to it. I have to be in a rural area where the SBA can go anywhere. My loans can be much larger than the SBA. They're capped at $5 million. I can go to 25. The SBA won't touch agriculture with a 10-foot pole. And I offer larger guarantees than the SBA. So debt is a large piece of it. At least that's what I'm seeing here in Southern Nevada. There's a couple of transactions that I think that have occurred in Southern Nevada have all been financed through owner's equity injection and debt.
So I think it depends on what you're looking for. So if you're trying to purchase land, there's $3 billion of capital right now sitting in funds that's allocated to go and buy land worldwide right now. And there's not enough land for them to buy at rates that are reasonable. So if you want to expand your farm and you want to have a partner, land funds are really a great place to go if you've got a reasonable price on land. If you have a growing operation that's spitting off 10 million in revenue, even better if it's 10 million in EBITDA, or if you can compile 6 or 7 operations that do that, there's a tremendous amount of money in private equity waiting in agriculture. I get a call like every 3 weeks. Hey, we're this huge private equity firm. We've got $2-3 billion in assets. Looking in the ag space, do you have anything for us? Do you want to come and work for us? Like, that's a common thing. So in private equity, they really want to get involved in agriculture. And if you look at the ag space, there's a whole bunch of companies, like a whole bunch of companies on the graph of under 10 million in revenue, and then it goes really small amount of companies, and then a lot more companies in the really big section, you know, the Monsanto, ADM section of the world. So if you can fulfill that middle space with a company, funding is really, really easy. Young technology companies, there's now 12 that I can count VCs in the space. When I started, there was 2. And so there's more money there, but it's tricky money, and you have to have all those things about it, IP and technology, great team. So there's money in those 3 categories if you're looking to build your business in those 3 ways. And then there's AgFunder.
Yeah, AgFunder.
.com.
So with respect to VCs, I think he's right. I think most VCs are geared towards some sort of software and technology development. I've been hearing that some of the clean tech VCs, the LPs that they've had, have been saying, okay, look more at ag tech. So if you have some sort of technology play that's maybe involved in indoor agriculture, that could be of interest to them. But if you're working on a business model and it's not a lot of technology involved, then it's probably going to be of less interest to the VCs. We just actually launched a campaign for an indoor ag company called Hometown Farms. And we've seen a lot of inbound interest from farmers and ranchers, actually. So people from South Dakota and Iowa were starting to reach out and wanted more information for this company. So these are high net worth individuals that get the ag space, but it's in a different kind of space that they're normally used to operating in. And maybe that's a good source of capital for more of the early stage startups. I know that Bright Farms here, they had some VC funding from NGen, which was, I think, they were more of a kind of a clean tech company, but I think they had a great business model and a great team of people around them that they were able to attract that capital in at a bite size that was interesting to the VCs. If you're trying to raise $200,000 or $500,000, you could really struggle, especially if you're just working on a market-based business model type operation.
Unless, if you're looking for $200,000 to $500,000, that's an area where I can help.
Well, so on that note, we've already started digging into this a little bit, but the 3 of you have very different approaches to funding businesses. So if we dig into it a little bit further, how should companies looking for funding really start to think about what the right fit might be between venture, crowdfunding, some type of debt, or have you seen opportunities where there's maybe some kind of mix where they can do a little bit of each? Because fundraising is a full-time job, and it's necessary, but it takes the management team away from running their business. So if the team is looking in the wrong direction, not only don't they get funded, but they're also not running their business. So to make best use of their time, what advice would you give them to start thinking through the process?
One thing I'd have companies do is look at comparables to what they're doing and find out how the successful companies raise capital. If you can't find a company like that, then maybe you're going to have some trouble as well. So if you're sort of a Bright Farms type operation. Look at how sort of Bright Farms got to where they are. They had a very, I think, a fairly differentiated product. Freight Farms is another example. I think they did some crowdfunding that really sort of proved out some of the excitement around what they were doing that allowed them to leverage that to move forward. So looking at comps is, I think, a good place to start, and that sort of helps you figure out where in the universe or what kinds of investors would be interested in what you're doing.
Yeah, so I think the thing that so venture capitalists have this, or private equity guys or hedge fund guys, they have this reputation of being arrogant. And know that that's somewhat true because there's a certain amount of separation that you need to put that kind of money to work and not get, into an emotional nightmare of a life. It's not entirely true. And the reason that idea comes about is because people don't see the investor as a customer, right? So if the person who's investing money into your business is in a way a customer, and they have a model, a thesis that they want, right? So you go to a guy who wants an apple and you say, here's an orange, and they kind of dismiss you. Oh, you're arrogant, you don't like my apples, but actually, you don't like my oranges, but they really wanted an apple. So to really familiarize yourself with the investor's thesis, how they go about their business, why they invest, and what they invest in is really an important thing, and it's really easy to access that information on the internet. I've gone through some of it even here. So I think really, and then the other thing is when you call people up, you ask them questions, right? It's amazing how many people come to me and just say, hey, I got this and this and this and this, and they haven't read the website. I tell people what they should come to me with. They don't do that. Or they don't ask me questions. Hey, what are you interested in? What are you doing? What are you seeing in the world? None of that happens. So I think treating the investor like a person is probably a good start, instead of as somebody who's going to make your dreams come true, because that won't work.
That's good advice. And to also be prepared. A lot of what Joe said there is to be prepared. Know who you're talking to. And speaking from the debt side, when Joe talked about talking to investors and VC people, know who they are, what they like to do. On the debt side, it's the same thing. When you're talking to a bank or a potential lender, they're all different. You may have bank A, bank B, and bank C. Well, banks are just like any other retail business. When you walk through a shopping mall, you've got a Wicks and Sticks, and you got a Spencer Gifts, and you got a Macy's. Well, you're not going to go to Macy's to buy a wacky T-shirt, and you're not going to go to Spencer Gifts to buy fine china. Banks are the same way. They all have specialties because they're just like a retail store, like that Spencer Gifts and that Macy's. You have to know what kind of bank likes which kind of transactions. You may walk into Bank A, and they love doing heavy industrial equipment loans, but they will no way, no how ever do a startup restaurant loan. You may walk into Bank B, they love doing startup restaurant loans and agriculture loans, but they would no way in heck do a heavy industrial equipment loan. Bank C may like something completely different. So you need to do your homework, and you need to figure out, and it's not easy, and you need to pull together a team, whether they be accountants, attorneys, people like us up here on this panel who know who these people are. Pull a team together to help you figure out who you need to talk to.
Yeah, in some ways, fundraising is really no different than hunting for a job. You need to do the diligence on the organization, because if they ask you, why do you want to work here, or in our case, why us instead of the investment group next door or the bank next door, you have to have a good answer. And fit is obviously the basic part of it. If you don't match their fit, nothing else really matters. They might like you, and they might think it's an interesting opportunity, but there's a mandate, whatever that mandate might be, and first and foremost, it has to match.
Yeah, I would even say that when I say there's no idea so good, bad management can't screw it up. I always swear there, so I have to correct myself to say screw it up. The reality is management starts with the investor. So getting an investor on board, it's not a heyday. It can be a nightmare, right? So you want to make sure that your investor and you can communicate well, that there's a good vibe between you two, that they have bring something besides money, because if they just bring money, it's very dangerous. So, you want to see that this person is going to add to your business. Interview them at some point in the process. Interview them the way you would interview any executive you're bringing on. Because if it's just dead money, it's okay. If it's value-added money, it's great. And a lot of money is actually value-subtracting money.
Well, David, I know you have several other programs that you wanted to mention, along with the one that you've already talked about.
Yes, earlier I mentioned that I have 16 programs that I administer, and
maybe not all 16.
No, I'm not going to go through all 16 because all 16 are not available to the public. Some are available to cities, counties, towns, and all that kind of stuff. But other programs that I have specific to our agriculture producers. One is called the Value Added Producer Grant, and this is really the only program that I have specifically for agriculture producers. And it's the only program that I have that's available to anybody anywhere. You could be in downtown Chicago and be eligible for this program. Again, Value Added Producer Grant. And this is specifically for agriculture producers who produce something and then turn that something into something else. For example, if you grow basil and you want to turn that basil into pesto. If you grow grapes and you want to turn that into wine. If you're a dairy farmer and you want to turn your milk into ice cream, etc. So you grow something, make something, turn it into something else. I have a grant that can help you do that. It's a crazy grant. It can't be used for things like real estate and equipment, but it can be used for planning, feasibility studies, and working capital. So if you're turning your basil into pesto, it can be used for bags, labels, your labor to actually do that. That grant comes up about once a year. The 2014 Farm Bill that was passed in January threw a whole bunch of money at this. So there's going to be a lot of money available in this program over the next 5 years at least. And again, it comes around about once a year, probably be coming around in August, September. You can either contact me or your local USDA Rural Development Office to find out more information. The third program I want to talk about is we're the government, so we have an acronym for everything. This is called my REAP program, R-E-A-P, which stands for the Rural Energy for America program. This is available to rural small businesses, ranchers, and farmers. If you're interested in renewable energy, so if you want to put up solar panels, wind turbines, geothermal, any of that stuff, I can help you do that with grants and or loan guarantees. So just to give you an example, it's not a 100% grant, it's a 25% reimbursement grant. So if you want to put solar panels on your building and it's going to cost $100,000, I can give you a grant for 25% or $25,000 of that. Essentially that helps you offset the initial cost and it offsets the payback period of that renewable energy project. So those are my big three projects, or three programs for ag producers. My Business and Industry Loan Guarantee Program. And I'll just add that we've done numerous projects in Southern Nevada for indoor agriculture and aquaculture and aquaponics. My average loan size is nowhere near these guys, where these guys are talking millions and millions and millions. My average loan size is probably, it's below $1 million in these types of transactions. So I'm working with smaller guys where these guys are working with bigger guys, probably. And so that's my three programs, the Business and Industry Loan Guarantee Program, the Value Added Producer Grant Program, and the REAP Program. Thank you.
Thank you. So when you look at funding a business or a venture, regardless of the stage of the business, obviously management is important, but whether it's management or the business itself, what do you actually look for? What characteristics do you look for in the team, in the business model, possibly history of past successes? What are you actually looking for when you make these decisions?
I'm scared I'm just going to repeat myself, but large total addressable market, good IP, large margins, great team, a real need that people see that they have, not a need that you think that they have, which is a big distinction. And great team, great team, great team.
Yeah, I mean, one of the things, because we have an online platform, so we're in particular looking for a company that has the ability to market themselves to raise capital. And so if you're poor at marketing yourselves, you're not going to really succeed. A platform like ours is a little bit like doing a mini IPO, and so if you want to sort of hide under a rock and not do the necessary marketing, it's not going to work for you. So we look for teams that do that. One thing I'd like to also add is that one of the great ways, if you're in an early stage of your life cycle and you're looking to raise capital, make sure you get a great advisory board around you. If that's sort of the human capital side of things. It's easier to raise human capital than real capital. And if you can't raise that human capital, meaning some fantastic advisors, you're going to really probably have a hard time raising real capital as well. So I would say take your business plan, start out, go find the best advisors you can, not just somebody who fills a role, but somebody who has who has credibility and pedigree that will then sort of halo on you. So as a team, you go out and you raise capital, and you can at least work with your idea and say, look, we've got a solid team of people around us, and we can drive this forward. If you can't do that, then you're really going to fall short when it comes to evaluating the team, and that's one of the first things that everyone's going to look at.
Most important thing that we look for when we're financing a project like this, and bearing in mind that we're looking at a public-private partnership, so a lender or a bank is going to loan you money, and then we're going to guarantee that loan. The most important thing that we're looking for is repayment capacity. Short and simple.
On the human capital side, I think that's a really important thing. So, for instance, if you're going to go and raise money with AgFunder and your plan is to go and have an IPO at some point, as an example, you want to know a couple things about having, say, 100 small investors, like how during the IPO process that could depreciate your stock, or if anything goes wrong and you have a down round, you're opening yourself up to lawsuits because it's investors who don't understand the way venture capital is played, potentially. At the same time, it might be the best place to go and raise the money because you can get a great valuation early on, or because you can pre-market your goods through AgFunder. So there's a lot of reasons to do it, but having a board of advisors who've been through that is a really, really important thing. Somebody who can see the path that has already walked down the path that you want to walk down. It just saves a tremendous amount of time, and it's amazing how few people ask for advice. I really recommend it.
I can't stress enough the value of advisors. And just to add one additional little kernel here, when you're thinking about advisors and looking for them, think beyond the people that you believe are accessible to you. If you ask them, they'll say yes. And you may have great relationships there where you should do that, but think bigger. Perfect world, these are the people, these are a short list of people, or the type of roles that you would want to get filled, and then use your network. This is all relationship management, right? So use your network to see if you can get to those kind of people to put together a stellar advisory board. Because if you do go down the crowdfunding path and you end up with 100 investors, well, an advisor may have given you some suggestions that wouldn't happen to you in the first place.
Can I make two comments on that point? You know, the SEC is about to come out with the rules on crowdfunding, and where people can actually physically get stock in your company. And that's going to happen probably in the next, 60 days or so. It's supposed to happen a year ago, but it hasn't happened yet. And I think that that's going to be a very viable solution for funding projects like this. But there are some red flags there. If you sell stock in your company to $10 a share to 1,000 people on the internet, that's going to dilute your stock position. And if you go to borrow money from a bank and to encumber yourself with debt, that's going to be an issue, because banks are going to have a problem saying, well, who are all these shareholders? If you go to get investment capital from gentlemen like this, you might have a problem, because they're going to look at your balance sheet and they're going to go, who are all these stockholders?
Just a note on the Title III. So we operate under Title II. So we consolidate accredited investors and also institutional investors on our platform. The Title III, I would just warn anyone thinking about doing Title III crowdfunding, because of the compliance costs are likely going to be too high for companies. And if you can raise that 250, 500,000 or $1 million from non-accredited investors, and that's what it is, then most likely you'll be able to raise that capital from accredited investors. So I would deter you from going after Title III crowdfunding, just again, and if you do, just do your homework, because I think the long-term compliance costs can make your cost of capital quite high.
And then the second point that I wanted to bring up is about advisory boards. Advisory boards are great, and it reminds me of the discussion 2 panels ago about, during the technology panel, when people were talking about how we don't share information amongst ourselves. And while I don't have a farming or ag background, I'm a business guy, and I've been a banker forever. But my family comes from farming, and I found that to be an interesting conversation, because it's interesting that this indoor ag group industry doesn't share information, because when you look at the history of farming, that's what they did. They formed cooperatives, and they shared information, they shared crops, they pooled all their resources together to make themselves better, to make their industry better. And I thought that was a great conversation to have in this room, and I think it's a great conversation regarding advisory boards. When I've been on people's advisory boards before, and I think it's great to even bring your competitors in on your advisory board. It brings fresh perspectives, and it lets you see things from a completely different point of view. I thought the advisory board should tie back somehow to that technology discussion.
The smartest guy I know, and one of the smartest guys I know in food, started a juice company, and all of his investors were other people who had started juice companies. So, and his board of directors were all of his investors who had also all started juice companies. So he had the guy from Adwala and the guy from Santa Cruz and all these different juice companies sitting on his board, putting their own money into it. You know, he took off like hotcakes, went so much quicker and faster than anybody else because he had all that advice.
And there's no better way to validate your business with future investors. Absolutely. We're starting to talk about various fundraising pitfalls. So since we're on the subject, where else have you seen companies go wrong when they start the fundraising process? You don't have to name names.
So I think a lot of companies start talking to investors before they're investment ready, and so they come to you with this sort of half-baked idea, and your initial impression is that they're sort of half-baked. And so, I mean, I believe you really need to pitch your product like 180 times, get that elevator pitch down so that it's really, really smooth before you start to talk to investors that you actually would want to invest. So, you know, tell your dog, tell your mom, tell your brother and your girlfriend and anyone who you can talk to, get that elevator pitch down, get yourself buttoned up. I would highly recommend spending a lot of time on TechCrunch. And understanding, there's a lot of discussion on engineering entrepreneurship on places like TechCrunch and Hacker News. There's lots of pitch decks out there. You can see what Airbnb did for their pitch deck. You can see what Mint.com, the guys that have had huge exits, and you can see what their seed stage pitch deck looked like. And so use these resources to reverse engineer what you may need to do. And then if you're an early stage company, particularly if you're looking for capital, I brought up the idea here earlier. Are you building a business or are you building an asset? And most investors are looking for somebody who's building an asset, not just a little business for yourself. And so if you're going out to investors, you need to show that you can offer them a return on investment, and you can, and yes, you have to do financial models, and because it does a sanity check and sort of scopes the opportunity, but you need all these materials ready before you start to seriously talk to investors.
A big issue some people I've seen, they have a really good idea, a really solid business. They go out to their friends and family. They raise the first $1 million because they're good talkers, and they raise it at a $50 million pre-money, and a VC sees that it's worth like $7 million pre-money by the time they've spent the $1 million. And so they are at a position where they have to dilute the people who invested originally. So you see, if you are really successful at fundraising at a really good cost, but that's not in market, make sure that it's enough money to get you to cash flow break even, because otherwise you're going to have massive issues coming down the pike. I think the other thing that you really want to think about when you're raising money is you personally, what you want from your business. A lot of people feel like their dreams will come true when the money comes in. you need to be really clear on what your dreams are, and you need to be really clear that the money's actually going to help you with that and not hurt you with that. So you see a lot of people who, they want to go raise venture capital money because it's going to make it all happen, and so they raise the money, and now they don't have control of their company. Or now they think that there's other people who have influence on their company that they didn't want to have influence on their company before. So really know what you're getting into. Call some CEOs and say, what was it like? What should I watch out for?
I'll agree with what these guys said. I think the most important thing is to be prepared. When you're going in to meet with somebody about money, you need to be prepared. Elevator pitch, very important. I mean, you have to show up, you have to know what you're talking about, you have to be ready, and you have to anticipate the questions that you're going to be asked, and you have to have answers ready for them.
Well, I'm sure there are quite a few people who want to ask questions, and so right before we get to Q&A, why don't we take just a brief look into present through into the future in terms of interesting investment opportunities. Where do you really see some of the more interesting and compelling opportunities in the ag and specifically indoor ag space right now, from the food production, the lighting technology, distribution, et cetera, as well as what do you see coming down the pike over the next couple of years as to where the really interesting opportunities might be that the audience might want to jump into?
I look at the indoor ag space, and to me, it's not an expertise of mine, and so it seems like a very noisy space. And so I would be most interested in technologies where you're taking technology risk and not market risk, a technology that could be applied across a number of players, and so you're not worrying about which particular indoor farming operation is going to be successful, but you're providing a technology that can scale through and be used in a large number of these operations. So whether that be some LED lighting solution, whether it be some monitoring, sensoring solution, and something that may be not easily replicable. The other thing is on the data side. If you can get a hold of proprietary data and then to create derivative data on that also creates a barrier to entry. That creates value for your company. Is that something that you can then go and leverage to raise additional capital? Because having those barriers to entry place you in a special position, obviously.
In general, it's not in my best interest to tell everybody like what's the next big thing that I'd want to invest in. So I don't typically do it. But I will say in this space, there's some technologies I've seen out there that are verging, if not have crossed the sound barrier of indoor ag, which means that they can produce food cheaper than you can on land. And if you can produce food, if you have a technology that can produce food cheaper than you can on land, that's all in costs, I'm really interested in talking.
Okay, I live in Southern Nevada, and Southern Nevada is really not known for its agriculture industry. So most of what I'm going to say is probably self-interest. I love living here. I think the indoor agriculture market is just waiting to boom here. There's over 2 million people that live in Southern Nevada. There's 40 million people that visit here every year. We have water issues, to put it mildly. I think that indoor agriculture is a solution to a lot of our problems. There's a couple of big resorts right over there with some high-name chefs. They all like to buy local if they can. They all want high-quality products that I know that indoor agriculture can deliver. I think this is we're 4 hours away from Los Angeles. We're 4 hours away from Phoenix. We're 4 hours away from Salt Lake City. Got a couple of big markets there. Last I heard, they have water issues in California. So I think there's going to be some issues for agriculture there. I don't know. It just seems to me like indoor agriculture might be a solution to a lot of those problems. And it seems to me that Southern Nevada may be well positioned to take care of some of those issues. I-11, which is going to go straight from Las Vegas to Phoenix, is going to be done in the next 10 years or so. We all have our fingers crossed. So I'm pretty excited about indoor agriculture. Despite the fact that I'm not an agriculture person, I do work for the Department of Agriculture, and I'm here to help businesses start and grow and to create jobs. And so I talk to a lot of people that are interested in indoor agriculture. And Maybe that's why I'm excited about it, because they're all excited about it, and hopefully you're all excited about it.
So who here is ready to hit these guys up for a check? Yeah. All right, take that back. All right, any questions here? I'm sure.
There's a man back there ready to hit us up for a check, and I'm definitely... Anybody who raises their hand on that, I want to hear.
What kind of EBITDA do you think is good in the ag marketplace? I mean, what are your investors looking at for a return on their investment? You come in and say, hey, man, we're making 4%.
As a VC, you're not going to like the answer to this. This is why we're invested in technology. I need to make sure that so when I invest in a company, odds are that 50 to 60% are going to fail, and 1 or 2 are going to break even.
That's a good VC.
Yeah, and that's a good VC. And then 1 or 2 might pay off the entire fund. So I need to make sure every investment I make can pay off the entire fund. So there has to be the ability for that company to have like at least a 10x return over a 7-year period of time. So that's the minimum, and you need to believe that it can be a $1 billion market cap company to invest in the traditional VC model. Now we've been lucky; we actually haven't had any failures yet, but still, that's the way we invest, and that's the way all VCs will invest. Private equity, 20% return year on year, very healthy and happy, and then debt, it's a whole different deal.
Hi, this question is initially for David. And it kind of picks on your last comment about potential for either accuracy on that. What do you envision about potential for USDA urban development division here in Southern Nevada as opposed to rural development? And if you are an urban producer here that's already here and that wants to expand into agriculture and something that's not value-added, that's local production, then it seems to be a little bit of a quandary as to how to work with your programs.
I agree, and that's a great question, and I think that there were some changes in the 2014 Farm Bill that were passed in January that our mission will not change. We're rural development. Our focus is going to remain rural. But we are the Department of Agriculture, so we're the food people. I think that they're still sorting out everything in the Farm Bill because it's like this big. I think that since we're at least during the next 2 years, who knows what will happen after the next presidential election? We'll get a new secretary and everything could completely change. But at least during the next 2 years, I think that while we will remain focused on rural, when it comes to food issues, certain things will change. I know that in the Farm Bill, I forget that like 15% of our business and industry loan guaranteed funds have been earmarked. That's probably a bad word to use because earmarked. Set aside for food hubs, and those food hubs can be located in urban areas. So I think as we move through time, when it becomes to a food-related issue, the rural component may be moved aside. And we're doing more and more about summer food programs, and those are not always in rural areas. And that's USDA rural development. And we're working hand in hand with HUD and other agencies to make sure that kids don't go hungry in the summer. And we don't care where those kids live. They could be in urban or rural areas. We don't want hungry kids. So to answer your question, I think that moving forward, some of the rural nature of the food programs, I think that we may be able to do more stuff in urban areas.
David, you spoke about your guaranteed loan program. Does that apply to companies that are less than 2 years old?
Yes. Okay. That's a very short answer, but it's a fact.
Because typically, from my experience with the SBA, they want you to be over 2 years in post-revenue. not the same with the USDA is direct.
No, and again, there's no SBA bashing here, but that's not an SBA rule. Our program, like the SBA, is a lender-driven program. It's up to the lender to make the loan. I can't guarantee a loan until a lender makes a loan. The SBA can't guarantee a loan until a lender makes a loan, because I don't loan money, the SBA doesn't loan money. They're guarantee programs. So if you have a lender tell you that, oh, the SBA doesn't do loans to companies that are 2 years old, that's not true at all. That lender doesn't do loans.
So then typically what do you see that the USDA is looking for to guarantee?
Well, we have three primary components that we're looking for. Is it an eligible borrower, meaning, U.S. citizen, all that kind of stuff? Is it in an eligible location, meaning is it in a rural area? We define that as a city or a town of a population of less than 50,000. And is it an eligible transaction, meaning is it an eligible legal business? And we don't have too many things that are on our forbidden list. We don't do golf courses or racetracks and casinos and brothels
Cannabis?
and things like that. Pardon?
Cannabis?
No, we cannot do that because that is illegal from a federal standpoint, despite what your state may do. So those three criteria are basically what we look at.
Hemp processing?
No, because that is
Hemp is
illegal.
legal in the new
Well,
Farm Bill.
I'm not. Well,
Growing
okay.
hemp is now legal.
I'd have to look into that.
All right.
But yeah, that would probably be all right.
Just going to stretch the boundaries a little bit.
Well, again, there are certain things that are legal here in Nevada
Right.
that I can't touch.
Nice. Any other questions?
David, you mentioned that you have 16 programs, and the two that I really noticed were the about rural energy projects, and the other one is about basically taking produce and turning it into a packaged good. I want to know, do you have any specific grants or programs specific to hydroponics or aquaponics?
That is a great question, and the simple answer is no. And I'll back up a little bit. But before I worked with the USDA, I was a banker, and I specialized in government guaranteed lending, doing SBA loans and USDA loans. And I did that for a very long time. I started when I was like 9. The most common question I've ever received as a government guaranteed lender and now working for the government is, hey, where can I get a grant for my business? I want to start a new business. Where can I get a grant? It's like an urban legend. Everybody knows somebody's brother's cousin's mother's sister's brother-in-law that got one. There is no such thing. You can't get a grant to start your business, to hire people, to buy equipment, all that kind of stuff. So the short answer is no. There is no specific grant program for hydroponic businesses, to buying equipment and hiring people and to buy land and all that kind of stuff.
So it couldn't be packaged into the program. If they were, for example, donating food to schools, could they get some kind of, reimbursement from the government if they were helping to feed the hungry in Las Vegas?
No. Not through my programs.
Yeah,
I mean,
right.
there may be some other kind of state grant program, or the city of Las Vegas may have something that I'm not aware of.
There's a website of all the federal, I think it just came out, of all the potential funding sources from a federal perspective that your company can go after. So I've sat with Secretary Vilsack, and he doesn't know all the programs that are giving out money through the Farm Bill, right? So there are places you can go and just look at all the potential ways to get funded through the federal.
There's only one site on the planet where you can learn about federal grants, and that's www.grants.gov. Every single federal grant is listed there for every single federal agency. If you ever see, some guy on TV with a green jacket with question marks, don't buy his book. Just go to grants.gov, because that's where everything's listed. If you ever see a TV commercial or a radio commercial or something in the paper about, hey, come to our seminar this weekend, we're going to show you how to get grants, it only costs $295, Save your $295. That seminar is a complete ripoff. All they're doing is they're taking your $295 and they're going to show you some fancy PowerPoint presentation for 2 hours, and then you're never going to hear from them again. Because the only place that lists federal grants is grants.gov. That's it.
Okay, thank you for that information. I wanted to also ask, you're saying that it's really important that Nevada finds ways to produce food because of water shortages and because the places where they currently are sourcing food are also having water shortages. What indoor systems do you think have the best future in Nevada?
Well, I'm not an expert on indoor agriculture, and like the technology guys that spoke 2 panels before, I'd probably defer that question to them. I do know that like Clark County, Nevada is 8,091 square miles. Las Vegas is 300 square miles, so there's plenty of land available.
Thank you so much.
Yeah, this question I think is mostly for Joe, but anyone can answer it. Looking at your LPs and the mandate that you have that has to do with investing specifically, in this space, but looking at your leaning towards technology, I mean, to me, one of the just elephants in the room that we all have here as people working in ag is that it's it's not as easy to ship, physical product as it is to ship code, right? And so our curve is just inevitably going to look different from like a tech startup, right? And so you were mentioning that your bar, your exit target is like 7 years out. Can you talk about maybe some of the ways that you and your LPs have talked in the back rooms about how you face that fundamental conflict that if you are investing in an area that doesn't have the same kind of growth curve as a lot of other kinds of technology company that VCs are focused on right now?
So I mean, Marone did have that kind of growth curve. So mostly we look for companies that we think can have it. So in that example that we've looked at companies that allow you to preserve your produce for twice as long in shipping, or that can preserve meat for a longer period of time. So we'll look at technologies that will actually facilitate something that can go along multiple markets, not just produce, but then meats or whatever. So we do it by the way we pick our technologies and the companies that we pick to invest in. That's how we look at it. And if they don't fit into that model, it's just not a match for us. There's other people to go and fund that, hopefully, but it's not us to do it. Because so I'm into sustainability, that's what we're doing, and I don't believe that should be a slow process, right? So one of our companies, for instance, saved 100 billion gallons of water last year, right? That's important to me to scale quickly, because I want to save $200 billion gallons of water next year, and I want to save 400 billion gallons the next year. And so I'm a fast growth kind of guy. That's what we do. And if it's not available in the company, then we don't invest.
We have time for one more question.
So with VC money, you guys are talking about the exit. And I don't know a lot about VC money or angel investors, but is that exit always or most of the time just selling the entire company to a larger company? Or is there, what are the other ways of an exit besides just finding someone bigger to acquire?
There's 2 possible exit opportunities in venture capital. One is 2 main, and one is mergers and acquisition, and one is IPO, going public. So it's just about the investor being able to get liquidity out. So any way that you can conjure for the person to put the money in to get the money out, with a lot more money coming out than went in, obviously, then that is an exit. Now in private equity, it can be very different. Private equity can take, if you've got 10 million in revs and or 10 million in EBITDA, somebody will come in and take a minority position in your company or buy your company outright. A whole bunch of ways to do that. grow the company and then sell their position to somebody else. So the private equity guys will take minority positions sometimes, but generally, so if you're building greenhouses, which I believe you are, right, and you see a way that there's a competitor that builds a different kind of greenhouse and you want to go buy them, then private equity would be a great way for you to infuse capital, be able to buy that other one. But at some point, you're going to have to go and you're going to have to find liquidity for your investor in one way or another.
Unless you're ridiculously profitable and just buy your investors out at some point, but that happens never.
I've never seen it in venture capital.
No.
I have seen it in private equity, but it's pretty rare.
All right, well, please help me thank David, Joe, and Rob for a great panel.
Thank you.
Nice.